Hi, welcome to this introduction to commercial real estate tax cash flows. Thanks for watching. Our purpose here is an overview of tax cash flows in commercial real estate and how they affect the commercial real estate pro forma. Where we're going with this and the next 3 videos on commercial real estate tax is finishing the pro forma and understanding how our investment is influenced by income tax that we have to pay as a result of income that we receive during our investment, and capital gains tax, what taxes we're liable for when we sell our asset at the end of the holding period. And the final video in the series is going to put everything together, produce an equity after-tax cash flow rate of return, the EATCF IRR, and that is an investment value used by any investor that is exposed to commercial real estate income and capital gains tax. There are some investors, like partnerships and REITs, which pass through their tax liabilities, so they generally tend to be interested in the before-tax cash flow investment value. All other investors, individuals and corporations, are interested in the after-tax cash flow rates of return. This slide is a point I think a lot of textbooks don't make very clearly, and that is the strategic role that debt and tax strategy plays in our commercial real estate investment decisions. So following the narrative in this course, everything up through NOI in the balance sheet is largely out of the investor's control. It's the investors having to mark prices to market or taking on and shedding some risk in the leasing process. So there is some ability to change NOI with a risk return trade through leasing. However, it's largely a market determined return. That would be our unleveraged returns. Debt was the first strategic part of commercial real estate investment where we really showed that investors can have differing approaches to debt strategy. You have your risk-averse investors that like to leverage as much as they can, take on higher risk, and they'll receive higher rates of return on their equity that they invest if the investments play out as they expect. On the other hand, they're subject to big losses if downside risk emerges and outcomes emerge, and they're then forced to take big losses, to have their asset foreclosed upon, or to have to raise additional equity to maintain solvent. Risk-averse investors, of course, would take on less debt and have less risk of negative events, but not have their equity returns inflated as much. So debt strategy is largely about placing the investor on a risk-return scale. And the return they get for each additional unit of risk, if you want to call it like that, is based on the wider capital markets. Tax is different. Tax is simply a return outcome. How much the government taxes is fixed. It doesn't change. So there's no variance in the cash flows that we receive from our property as a result of the tax code. Taxes apply only after we've realized our returns. What we're doing now is we're separating those returns into those that the government has the ability to capture, and those that we would then pocket after we've fulfilled our government tax obligations. So therefore, it's pure return with no effect on risk. If we pay less tax as a result of strategic tax minimization, we increase our returns, but the overall risk of the investment stays the same. If we pay a lot of tax, then our overall returns decline, but the risk stays the same. So in your professional careers, you will be having a lot of conversations with investors and your colleagues about tax minimization, how to do it, what's the best strategy, because it is a pure return play. There's no risk being traded in tax strategy. I shouldn't say no, but there's very little risk. Some investors do take some speculative investments based on expected changes in tax policy, but I'm going to exclude those. I'm going to assume that the tax policy is known and pretty obvious ahead of time. So next slide, next topic is, what do I mean when I say tax cash flows, right? I can think of 4 or 5 of them right now. We pay tax on the income we receive. We pay tax on the capital gains or the price appreciation if we make a capital return in our investment. We pay tax when we buy an investment because we have filing fees, maybe stamp duties depending on where we live. We also pay property tax to local and municipal governments or state governments every quarter or every year, and all of those can be called taxes. So what am I going to talk about? Specifically, it's those first 2. Taxes based on the income we receive and the capital gains at the end of the investment. The other 2 we've actually already talked about. So when we buy and sell an asset, you've seen a line item that probably says purchasing costs. Well, those include stamp duties and taxes that you pay for the acquisition of real estate. Those are simply purchase costs, acquisition costs. We've also already talked about property taxes. Because those recur every year and are the same for any investor, they're simply operating expenses. We can also use the leasing process to recoup those property tax payment liabilities from our tenants if we use a net lease structure. So those have already been accounted for above NOI in our unleveraged cash flows. So we're specifically talking about income and capital gains tax. Now, a brief disclaimer that you'll read in any textbook or any lecture on this topic. We're a real estate class. This is a broad overview of the taxation landscape. If you're actually in the game, make friends with those classmates studying accounting, because you're going to need their advice. As soon as you make a real deal, you're going to want specified tax advice related to the state and municipality that you're investing in, and specific rules around how to take advantage of federal tax programs or state tax programs. All of that is not going to be covered in these lectures. I'm also going to focus on tax minimization, because that's where my claim that we can change our tax strategy and just affect our returns without risk. That's the process of tax minimization, where we legally reduce our liabilities to pay tax. Tax avoidance is illegal. Now, some investors might think, okay, if it's illegal, it just means I'm taking on more risk. Sure, but we're focused on following the law and being legally appropriate investors, so we're not going to deal with the potential returns that we might get from tax avoidance, or the illegal side of tax minimization. So in a minute here, I'm just going to briefly go over the 2 accounting frameworks to give you an idea from a high level where the next few videos are going to go. So we've gotten to equity before tax cash flows. I'm going to start with the income side. So we've got our income, equity before tax cash flows. We're going to pay taxes on that. That's our income tax. And we're going to the outcome is our equity after tax cash flows. So that's where we're going. Now, you'll notice that NOI starts on the right, and a lot of the complications of calculating income tax go into how we adjust NOI for actual income that's subject to tax. And that next video will go over that. On the capital gains side, again, you might think it's as simple as purchase price, sale price minus purchase price equals our capital gain, multiply that by our tax rate, and voila, we're done. In some countries that works, but in the US, it's slightly more complicated than that. So again, you'll see the general framework is equity before tax cash flows minus our capital gains tax. So this is the cash flows associated with the sale, equals our equity after tax cash flow. Okay, simple, but again, calculating the taxes due is going to need a whole nother video. So you'll see we actually end up with book values, so accrual accounting comes into this. It's the only time in the pro forma where we're going to have cash flows that aren't actual real cash flows. They're accrual based cash flows. And we're going to sell an asset that's probably depreciated a lot lower than what we originally bought it for. We're going to have depreciation recapture. We're going to have free and clear capital gains. And we're going to learn how to calculate our capital gains tax liability. And I'll also, in the video on capital gains tax, talk a little bit about exit strategy. Okay, if you don't want to pay capital gains tax, how do we get around it? Not get around it, but how do we minimize it, or specifically, how do we defer it? So that's it for this overview. I'll see you next in the video on income tax from commercial real estate.